Hello friends, it's me once again, Balbu Jimmy, and today we shall be handling a topic in business associations, and this is lifting the corporate veil. We are going to lift the veil together and see if this is where we can lift the corporate veil. My request is that you may please subscribe and like my videos. So I'm going to first take us through an introduction, handling lifting the corporate veil. What we need to understand is that incorporation of a company by registration was introduced in 1844, and the doctrine of limited liability of a company followed in 1855, and subsequently in 1897, in the case of Salomon versus Salomon and Company, the House of Lords effected these enactments and cemented into English law the twin concepts of corporate entity and limited liability. So in that case, the Apex Court laid down the principle that a company is a distinct legal person entirely different from the members of that company. And this principle is referred to as the veil of incorporation. The chief advantage of incorporation, from which all the others follow, is the separate entity of the company. So in reality, however, the business of the legal person is always carried on by and for the benefit of what? Of some individuals. So in the ultimate analysis, some human beings are the real beneficiaries of the corporate advantages. For while, by fiction of law, a corporation is a distinct entity, yet in reality it is an association of persons who are in fact the beneficial owners of all the corporate property. And what the Salomon case decides is that in the questions of property and capacity, of acts done and rights acquired, or even liability assumed thereby, the personalities of the natural persons who are the company's corporators is to be ignored. Yes. So, this theory of corporate entity is indeed the basic principle on which the whole law of corporation is based. So instances are not few in which the courts have successfully resisted the temptation to break through the corporate veil. Courts have really attempted to break through the veil and see what is inside. When we talk of the veil, it is instances where courts will have to ignore the concept of a company being a corporate entity, having its liabilities different from the members. So courts will have to go deep and look inside. That is basically what corporate veil means. So this theory cannot be pushed to unnatural limits. There are situations where the court will lift the veil for incorporation in order to examine the realities which lay behind the corporation. Sometimes this is expressly authorized by statute, and sometimes the court will lift its own volition. The human ingenuity, however, started using the veil of corporate personality blatantly as a cloak for fraud and improper conduct. They started misusing this concept of corporate entity without liability of the members, but they started misusing it to perpetrate fraud and improper conduct. Thus, it became necessary for the courts to break through or lift the corporate veil and to look at the persons behind the company who are the real beneficiaries of the corporate fiction. So the definition is that lifting of the corporate veil means disregarding the corporate personality and looking behind the real person who is, or who the persons who are in the control of the company. In other words, where a fraudulent and dishonest use is made of the legal entity, the individuals concerned will not be allowed to take shelter behind the corporate personality. So in this regards, the court will break through the corporate veil, the corporate shell, and apply the principle of what is known as lifting or piercing through the corporate veil. When you look at the case of United States versus Milwaukee Refrigerator Company, that was in that case, the position was summed up as follows: a corporation will be looked upon as a legal entity as a general rule. But when the notion of legal entity is used to defeat public convenience, justify wrong, protect fraud, or defend crime, the law will regard the corporation as an association of persons. There we shall not say these people are not liable since a company is a distinct entity from them. We shall regard the corporation as an association of those persons. Yes, I hope someone understands that. So furthermore, when you look at the case of Littlewood's Mail Order Stores versus Inland Revenue Commissioners, that is 1969, Volume 1, Weekly Law Report at page 1241. Lord Denning observed as follows: the doctrine laid down in Salmon versus Salmon and Salmon Company Limited has to be watched very, very carefully. It has often been supposed to cast a veil over the personality of a limited liability company through which the courts cannot see. But that is not true. The courts can and often do draw aside the veil. They can and often do that. Pull off the mask. They look to see what really lies behind. That is Lord Denning in Littlewood's Mail Order Stores versus Inland Revenue Commissioners. And still, similarly, in the case of Dunlop Nigerian Industries Limited versus Forward Nigerian Enterprises Limited and Farod, it was observed that in particular circumstances, for example, where the device of incorporation is used for some illegal or improper purpose, the court may disregard the principle and lift the veil. The veil may be lifted by the judiciary or by statute. When we say the judiciary, we mean the courts will, its discretion, see that the veil needs to be lifted, or it can be by statute. Like when I say by statute, means the law, the act is providing for lifting the veil. So to start with, let's start with judicial lifting of the veil. What we need to understand is that it is difficult to be precise about the circumstances in which a judge will lift the corporate veil. However, what is clear is that on occasions, the Salmon decision has caused problems, and the courts have had to remove the veil of incorporation to enable them to see the commercial reality behind the corporate personality. But it is important to bear in mind that there are only a few examples of the courts removing the veil of incorporation, and the overriding concern is to protect the corporate form. There is a great reluctance by the courts to depart from the Solomon principle. So as courts try to lift the veil, they try much as possible to ensure that they do not divert from the Solomon principle, and that is corporate entity. Yes. Yet it is clear that the courts will remove the veil of incorporation in cases where the incorporator is trying to avoid an obligation or achieve an unfair advantage. There are some occasions where it is clear that the courts will remove the veil. Yet the important thing to remember is that any list, including the other that follows, is not exhaustive, and it is not known where the boundary lies between a court lifting or removing a veil of incorporation and leaving it intact. So these are the instances where the judiciary will lift the corporate veil. Number one, it is fraud or improper conduct. The courts have been more than prepared to pierce the corporate veil. When I say pierce, is the same as lifting the corporate veil. When it feels that fraud is or could be perpetrated behind the veil. The courts will not allow the Salmon principle to be used as an engine of fraud. And here we look at the case of Guilford Motor Company Limited versus Horn. That is 1933, Chancery, at page 935. Where Mr. Horn was an ex-employee of the Guilford Motor Company, and his employment contract provided that he could not solicit the customers of the company. And in order to defeat this, he incorporated a limited company in his wife's name and solicited the customers of the company. The company brought an action against him, and the Court of Appeal was of the view that the company was formed as a device in order to mask the effective carrying on of business of Mr. Horn. And in this case, it was clear that the main purpose of incorporating the new company by Mr. Horn was to perpetrate fraud. Thus, the Court of Appeal regarded it as a mere sham to cloak his wrongdoings. Yes. The other case you can look at is Jones versus Lipman. That is 1962, Volume 1, Weekly Law Report, at page 832, where a man contracted to sell his land and thereafter changed his mind in order to avoid an order of specific performance. He transferred his property to a company, and Russell J. specifically referred to the judgments in Guilford versus Horn and held that the company here was a mask which Mr. Lipman holds before his face in an attempt to avoid recognition by the eye of equity. Therefore, he awarded specific performance both against Mr. Lipman and the company. The second instance is agency. Others may say agency. It depends on your local language. Agency or trust. So where a company is acting as an agent for its shareholders, the shareholders will be liable for the acts of the company. It is a question of fact in each case whether the company is acting as an agent for its shareholders. There may be an express agreement to this effect, or an agreement may be implied from the circumstances of each particular case. For example, when you look at FG Films Limited, that is 1953, Volume 1, Weekly Law Report, at page 483, where an American company financed the production of a film in India in the name of a British company. The president of the American company held 90% of the capital of the British company, and the Board of Trade of Great Britain refused to register the film as a British film. And in this case, it was held that the decision was valid in view of the fact that British company acted merely as a nominee of the American company. So the third instance is single economic entity. Sometimes it is in the case of a group of enterprises, the Salomon principle may not be adhered to, and the court may lift the veil in order to look at the economic realities of the group itself. And as such, corporate veil may be pierced where groups of companies can be treated as partners. In this instance, we can look at the case of DHN Food Products Limited versus Tower Hamlets. That is 1976, Volume 1, Weekly Law Report, at page 852, where DNH was the holding company in a group of 3 companies, and there were 2 subsidiaries wholly owned by DHN. One subsidiary owned land used by DHN, the other owned vehicles used by DHN. The land was subject to compulsory purchase, and DHN sought compensation for disturbance of its business. And in the Court of Appeal, Lord Denning, Master of Roll, that is MR, said, these subsidiaries are bound hand and foot to the parent company and must do just what the parent company says. This group is virtually the same as a partnership in which all the 3 companies are partners. They should not be treated separately so as to be defeated on a technical point. It was therefore held that DHN was entitled to claim the separate corporate personality was overridden in this case. However, whether the court will pierce the corporate veil depends on the facts of each case, just as I had mentioned earlier. The nature of shareholding and control would be indicators whether the court would pierce the corporate veil or not. Number 4 is public interest. The courts may lift the veil to protect public policy and prevent transactions contrary to public policy. The courts will rely on this ground when lifting the veil is the most just result, but there are no specific grounds for lifting the veil. Thus, where there is a conflict with public policy, the courts ignore the form and take into account the substance. Number 5 is illegality. The courts have been prepared to draw aside the veil of incorporation in order to establish that a company was owned by nationals of an enemy country, so that to do business with it would be illegal because it would be trading with the enemy. And in this instance, we look at the case of Daimler Company Limited versus Continental Tire and Rubber Company of Great Britain Limited. That is the case of 1916, Volume 2, Appeal Cases at page 307, where in this instance, a company was incorporated in England for the purpose of selling in England tires made in Germany, but by a German company which held the bulk of shares in the English company. The holders of the remaining shares, except one, and all the directors were Germans, residing in Germany. And during the First World War I, the English company commenced action for recovery of a trade debt. It was held that the company was an alien company and the payments or debt to it would amount to trading with the enemy, and therefore the company was not allowed to proceed with its action. Yes. Number 6 under judicial lifting of the corporate veil is for benefit of revenue. It is important to understand the court has the power to disregard corporate entity if it is used for tax evasion or to circumvent tax obligations. And the clearest illustration in this case is it is Re Dinshaw Manekji Petit, where the assessee was a wealthy man, enjoying huge dividend and interest income. He formed 4 private companies and agreed with each to hold a block of investment as an agent for it. Income received was credited in the accounts of the company, but the company handed back the amount to him as a pretended loan. This way, he divided his income into 4 parts in a bid to reduce his tax liability. But it was held that the company was formed by the assessee purely and simply as a means of avoiding super tax, and the company was nothing more than the assessee himself. It did no business, but was created simply as a legal entity to ostensibly receive the dividends and interest and to hand them over to the assessee as pretended loans. I hope someone understands that. Yes. So those are the 6 instances where courts will lift the corporate veil. Yes, that is judicial lifting of the veil. So as I mentioned earlier, I said there are 2. There is judicial and statutory lifting of the veil. So now we are going to handle statutory lifting of the veil. A good starting point for the discussion of such statutory provisions is Lord Diplock's statement in the case of Dimbleby and Sons Limited versus National Union of Journalists. That is the 1984 Volume 1 Weekly Royal Report 427 case, when he observed that the corporate veil in the case of companies incorporated under the Companies Act is drawn by statute, and it can be pierced by some other statute if such statute so provides, but in view of its region, data, and its constant recognition by the courts, since Salmon versus Salmon and Company Limited, one would expect that any parliamentary intention to pierce the corporate veil be expressed in clear and unequivocal language. That was made by Lord Diplock in Dimbleby and Sons Limited versus National Union of Journalists. Yes, so we shall proceed and look at the first instance where a statute is providing for lifting the veil. Under our Companies Act, yes, under our Companies Act of 2012, Section 20 provides that the High Court may, where a company or its directors are involved in acts including tax evasion, fraud, or where, except for a single member company, the membership of the company falls below the statutory minimum, lift the veil. You're saying except for a single member company. For example, when you look at the public company, the minimum is 7. Yes. So when it falls below 7, then the veil may be lifted. Yes. Yes, that's it. And the second one is provisions in relation to names. When you look at Section 117 of our Companies Act of 2012, the advantages of the corporate form can be removed where the director or other officer does not maintain the company's name outside its place of business, or where the company's name does not appear on the company's letters, notices, and bills, and so many others. Please have time and look at this Section 117 as well as Section 20 of our Companies Act of 2012. Number 3 is investigation into related companies. Still, let's address our mind to Section 175 of our Companies Act of 2012, where an inspector has been appointed by the registrar to investigate the affairs of a company. He may, if he thinks fit, also investigate into the affairs of any other related company and also report on the affairs of that other company, so long as he feels that the results of his investigation of such related company are relevant to the main investigation. Please make yourself familiar with Section 175 of our Companies Act of 2012. Yes, so the fourth is taxation. Here we shall make ourselves familiar and befriend and take the Income Tax Act to a date. When I say taking the Income Tax Act to the date, that means we should really put it next to us. This is what is going to help us sort this instance of taxation. So under the Income Tax Act, the veil of incorporation may be lifted to ascertain where the control and management of the company is exercised in order to determine whether it is a Ugandan company for income tax purposes. So here the veil will be lifted to look at what is the controlling hand in this company. If it is a foreign, if the controlling hand and the management is foreign, then we shall have to levy a slightly higher tax, because these guys, like the dividends are always going out. Find many of its members are not our locals here. So yes, we have to lift the veil and see who controls and manages this company for purposes of taxation. There the veil will be lifted. And the fifth is holding and subsidiary companies. So in this instance, they are saying that where companies are in a relationship of holding and subsidiary companies. When I say holding and subsidiary companies, I don't know whether someone understands me, but a holding company is the same as a parent company. And this is a company that has shares in another company, and the shares it has in the other company, are the majority shares. Actually, this company becomes the majority shareholder in the other company. That is, if we consider the 50+1 rule. Yes. So they are saying that where companies are in a relationship of holding and subsidiary companies, group accounts are usually presented by the holding company in a general meeting. And in this regard, the holding and subsidiary companies are regarded as one for accounting purposes, and the separate nature of the subsidiary company is ignored. So when you look at our Section 157 of the Companies Act of 2012, it requires each company to keep proper books of accounts with respect with respect to, number 1, money received by the company and from what source. Number 2, money spent and what it was spent on. Number 3, all sales and purchases of goods made by the company. Next, the assets and liabilities of the company. Yes, so these accounts are meant to give a true and fair view of the state of the company's affairs and to explain its transactions. So directors of the company are required at least once a year to lay before the company in a general meeting a profit and loss account, that is income and expenditure account for non-profit making companies, plus a balance sheet. Yes, when I say balance sheet, I don't know whether someone gets that. Someone who did economics, someone who did entrepreneurship, someone who did accounts, someone who did commerce gets to be well there. So in this regard, the holding and subsidiary companies are regarded as one for accounting purposes, and the separate nature of the subsidiary company is ignored. Yes, so as discussed there, those are the instances where the corporate veil will be lifted. We have the judicial lifting of the veil and statutory lifting of the veil. So in conclusion, thus, it is abundantly clear that incorporation does not cut off personal liability at all times and in all circumstances. Honest enterprise by means of companies is allowed, but the public is protected against cheating and humbuggery. So the sanctity of a separate entity is upheld only insofar as the entity is consonant with the underlying policies which give it life. And thus, those who enjoy the benefits of the machinery of incorporation have to assure a capital structure adequate to the size of the enterprise, and they must not withdraw the corporate assets or mingle their own individual accounts with those of the corporation. So the courts have at least at some times seized upon these facts as evidence to justify the imposition of liability upon the shareholders, and the act of piercing the corporate veil until now remains one of the most controversial subjects in corporate law. There are categories such as fraud, agency, sham or facade, unfairness, and group enterprises, which are believed to be the most peculiar basis under which the law courts would pierce or lift the corporate veil. But these categories are just guidelines and by no means far from being exhaustive. So thank you for listening. I remain Baluku Jimmy. I hope someone finds this helpful. Yes, of any question, you can still reach out, and I'll have to explain more about lifting the veil. We need to really lift this veil together. So please endeavor to subscribe and then like, and you could share to a friend. Yes, it is not good to be mean. When you get something helpful to you, you need to share with your friends. So thank you. Please have a nice time.